Wealth and Wisdom is brought to you by the Johannesburg Stock Exchange.
Hello and welcome to Wealth and Wisdom. I'm James Boardman, and with me tonight is Stephen Brown. He's a hedge fund manager, a long-only manager, who works at a company called Fairtree Capital. Welcome to the show, Stephen.
Thank you, James.
So, Stephen, what funds do you manage?
At Fairtree, we're a boutique fund management house. We're based in Cape Town. We are predominantly a hedge fund business, which manages funds across a couple of different asset classes, being equities, fixed income, as well as commodities. We have single strategy funds, and we have multi-strat funds as well. And then recently we've moved into the long-only space, launching a general equity fund.
So I'm quite interested because the reason I brought you onto the show was I was reading a hedge fund magazine called Hedge News Africa, and you guys had quite a serious prize. It was like one of the best new funds of the year, I think, for that multi-strategy. That return was kind of mind-blowing, 45% in 1 year. I mean, that's the Fairtree Wild Fig multi-manager, multi-strategy fund. Can you tell me a little bit about how that works?
Yeah, the Wild Fig is one of our new funds. We're very excited about the Wild Fig. It's a multi-strat fund. So what we do with this product is that we've got three underlying building blocks within it. We've got our commodities relative value fund, we've got our fixed income arbitrage fund, and then we've got our long-short equity fund that's in there. So we allocate capital to the three funds on equal allocation. Okay, and what that does for us is that we believe it limits the downside risk, because these three products are completely uncorrelated. We're dealing with different managers in different markets. And then ultimately what the Wild Fig does is it amplifies the returns by adding leverage to the product. So it's a multi-strat fund with the three building blocks underneath it.
Okay. So then do you then add that gearing at the last step on those returns? So I mean, you're not gearing each fund and then... But I mean,
correct.
That's the net effect.
That's correct. Okay. And what it has done is that, if one looks at the underlying individual building blocks, the volatility of the portfolios is pretty low. So
because they offset each other, So the one will be doing well, the other will be doing poorly.
Quite right. But then by amplifying the allocations and by adding the leverage, what it does is it enhances the volatility of the portfolio to somewhere around about what the all-share index is. That's where it's been over time. But we've generated significantly higher returns in the product. So your risk-adjusted return is significantly better than what we've had out of the all-share index. And that's just one of the many products that we're offering at Fairtree.
That's quite fascinating, because they always say you should diversify your portfolio, but you guys are kind of doing an aggressive but diversified portfolio that provides those kind of uncorrelated returns. Because I mean, for example, the agris market, we've got this huge drought in the States at the moment, and I mean that is having a huge impact around the world. Soybeans are running, maize has gone up to 2,700 a ton. It's amazing. And then in the fixed income environment, we've got this quirky low interest rate environment that is leaving a lot of people scratching their heads and trying to figure out how to make it work. And then the equities just keep on going from strength to strength.
Yeah.
So it's you get that diversified return from different places. It's a very novel approach. So in the equity space, what sort of approach do you guys take? Do you do a top-down sort of saying we think these sectors could outperform, or do you do more bottom-up? This is an individual great company.
Yeah, I think it's important to understand that within our equity building blocks, we've got three different strategies. We've got a market neutral fund, which is there to generate steady returns over time. So we want to have a cash plus return for that product at a very low volatility. So that fund's done well over time with a volatility of around about 5%.
Wow.
If one considers that the
Aussie's about what, 18?
Yeah, about 17, 18, and this fund has done about 13% per annum versus the Aussie of about 17. So that's a low vol fund. Then we have a conservative relative value long short fund, which basically takes the same relative value opportunity sets and adds a bit of direction with it. And then we have an aggressive long short fund, which is the fund that I'm running now, which we launched last year, which tries to capture a bit more of the upside of the market. So we're willing to take on a little bit more beta into that portfolio. But at the same time, clients need to be aware that fund will have a little bit more downside when markets are coming back a little bit. So these are different products which are run with different mindsets, if I can put it to you that way.
Different sort of core target audience almost. I mean,
Yeah,
you know, those more aggressive ones,
Yeah.
generally the thinking is when you're younger, you go for the more aggressive products, and when you're older, you go for the more conservative product because
Yeah.
you don't have the time to recover.
Yeah, quite right. I mean, look, you know, and that's right, and that's why we offer single strategy funds as well as multi-strat funds as well. You know, in terms of the portfolio construction, the investment idea generation, we all have the same philosophy, the same investment process, the same style, in that we believe that your best idea generation comes from a combination of getting the top-down macroeconomic environment right. One doesn't have to forecast it, but as long as you understand the major drivers, what's going on globally, you'll understand what the effect is on the bottom-up stock selection. Ultimately, you build portfolios from a bottom-up perspective, but the idea generation, those stocks are going to be influenced by the macro environment.
Yeah.
So we combine both of them to find the stocks that we like, and then we look for relative value opportunity sets in the market neutral
So
fund.
in sectors, I mean, you're looking at, I mean, what you're saying by relative value is this is really expensive, this is really cheap. This has got to come up, that's got to go down. So let's go short that one, long this one. Hopefully we'll get some sort of alpha on both ways. By being long and short, you're cutting out the beta, which is just the general market noise that the market's going up. So you're trying to separate out that, and then by doing that, hopefully you get a bit of an uncorrelated return.
Quite right.
So that's what they mean by market neutral, is you equally long and short, you've got some hedges in place, you're hopefully going to return, but you don't really mind what the market does. So with your, I mean, where do you guys start? I mean, I know obviously they've got to work together. Do you start with saying this is attractive in a macro picture, or do you start, this is a really attractive little company in this sector, I think the valuation's cheeky enough that we should be able to make money on it?
Look, ultimately investing, it's a continuous process of looking at the macro environment and looking at bottom-up stocks and looking at valuation. So markets continuously move, stocks continuously move, and you have to reassess permanently where you are, where the stock is relative to your expectations, where the market is relative to your expectations, where the environment is relative to your expectations. But we'll continue to try and find opportunity sets of, exactly as you were saying, stocks which we think are expensive versus stocks which we think are cheap, and put a pair trade on. And what we tend to do is we tend to work within sectors which are correlated within each other, and that will reduce the diversion of the returns of the fund.
That's very interesting. We'll be right back after the short break with Stephen Brown from Fairtree Capital.
JSE Safex style options, a great choice.